Today on the podcast, we have Blaine Crissman. Blaine is a private equity growth fund manager, and he's been focused on deals in the Midwest. We cover kind of a wide range of topics today that are pretty important to entrepreneurs. Blaine has a wealth of just experience in the finance space and a kind of an interesting history professionally. I think you really will find valuable. So sit back and enjoy this episode with Blaine Crissman. Okay, welcome to the podcast today. I'm super excited to talk with Blaine Crissman. Blaine is the head of Badlands Capital. They're a private equity growth fund that is based in Sioux Falls, South Dakota. And so I just, wanted to say welcome and thanks for joining, Blaine. It's super excited to have you here and have a quick conversation here over the next couple hour here.
Well, thank you for inviting me, Todd. I know working with you over the past couple of years on several technology companies, I really respect your background and what you bring to technology companies in this region. So I look forward to the conversation.
Well, thank you. I appreciate it. That's very nice. But mostly it's going to be about you today. So I just want to make sure we're clear about that. I'm the one doing the podcast. Why don't you give us a little bit of...
We're done.
No. Why don't you give us a little bit of background about how you ended up in your role? I think it's kind of interesting how, like a lot of entrepreneurs, they meet these people. And then I think there's some interest in like, how did you get there and like what that job really looks like? So maybe you just give us a little bit of background on how you ended up in the role you're in today.
Yeah. The punchline is I'm old, so it's taken a while to get here. I started, graduated from Augustana in South Dakota, was a commercial banker, Rapid City in Sioux Falls early in my career. I always liked finance and I liked reading, and this was in the 90s. So books that had come out were Liar's Poker by Michael Lewis, The Big Short, Blindside. And by Barbarians at the Gate about the KKR, RJR Nabisco buyout and early stages of private equity. And I just thought, I'm never going to see that doing what I'm doing, lending to businesses in South Dakota. So I decided to reinvent myself. I applied to graduate schools. I was accepted and received an MBA from Duke University. And after graduation, ended up in Chicago. It turned out for almost 20 years. The first 5 years, investment banking, high yield bonds, providing debt to the very leveraged buyout transactions I'd been reading about. So that was pretty cool. I learned a lot, met people, was recruited to a private equity fund in Chicago and was there for several years. And eventually left and raised a private equity and subordinated debt fund with some other people in Chicago, investing nationally, private equity transactions, more later stage type. But we did some early stage. We were an investor in Angie's List, for example. I didn't realize it at the time, but I had wanted to really be an entrepreneur as much as get involved in more advanced finance. So eventually, 2011, I moved back to South Dakota and started Badlands Capital. Badlands Capital investing equity, Series A really through mature buyout in companies in the Midwest. And so we've invested in software businesses, one medical device company, some other early stage companies, as well as growth equity and control buyout in manufacturing businesses. So I've seen multiple stages, multiple industries, and given the length of time I'm investing, I saw the dot-com burst, the global financial crisis, the pandemic, increasing interest rates. So I think I've also seen several points in the capital market cycle as well.
Yeah, I think that's good. It's a time horizon that you've seen a lot of different cycles, and so that's pretty important. So maybe that pivots us to a little bit to what do you think about the fundraising kind of landscape today? I know with zero interest rates, in the last couple of years, that changed the markets versus kind of where we are today. And so maybe give me a little bit of flavor on how you see these capital markets working today.
Yeah, the context is, again, the global financial crisis was a major shock globally on rates of return, access to capital, liquidity. And I think the especially in the United States, the response of Federal Reserve and injecting capital into the system, lowering interest rates. And keep in mind, this was 2008, 9, 10, where they dropped to basically a zero interest rate environment. So it's lasted for more than a decade, or it did.
Yeah.
And during that period of time, I think another important consideration driving capital markets today was there are large multi-billion dollar institutional investors needing to pay pension returns in the future. And so they have actuarially forecast returns in the 7 to 10 to 11%. Well, you couldn't get that from fixed income. A lot of the public equity markets, you couldn't get that. And so it pushed them further onto the risk horizon to try and hit their forecast returns. So not only was there zero interest rate, low interest rate environment at the portfolio company level, but there were billions of dollars flowing into the fund structure, venture capital and private equity, reaching for returns. And so a combination of both of those were the result of just an easy money environment for a decade. And it was negative unit level economics, getting funded so long as you could show top line growth, raising tens of billions of dollars on an idea and a couple of people. And so that lasted for probably as long as we've ever seen in the United States capital markets. And now that interest rates have gone up, we've seen a tightening of inflows into venture capital and private equity. So the supply side is constricted. On the portfolio company side, it's more expensive to do almost anything.
Mm-hmm.
And the combination of two of those is there just isn't as much capital available to early stage companies.
Which I think we both agree maybe is a good thing, right? I think it's changing some of the behavior. It's making growth at all costs. If it's not profitable, a thing of the past. I think it's being more capital efficient, which I think is a positive thing. I'm curious though, so how do you perform in that environment back then, and then basically perform in this environment today? Your fund kind of crosses both of those, and so how has your evaluation and investment decisions and how has that changed with the entrepreneurs as you've gone through, let's say, the last 24 months?
Mm-hmm. Leading up to the past 24 months in the easy money environment, you could get a company up and running, funded, seed, Series A, showing top line growth, again, the product market fit and some acceleration of revenue, and be able to sell, to your point, off of revenue growth. And it was as much a capital markets arbitrage as it was building a sustainable business. So long as you could show growth, valuations were increasing, you could sell to someone else and deliver the returns to our investors as a fund manager. The companies themselves, the founders and management teams were then focused again on developing an appropriate core product with additional features, but it was customer acquisition and growing top line. And depending upon what type of technology, if it was software, if you're delivering the 70 to 80% gross margin, then venture capital could decide which levers they were going to pull below that to fund customer acquisition, product development, customer success. And so money just kept flowing into that, revenue growing at a high margin, regardless of whether you had visibility on reaching cash flow positive. And so a lot of businesses were funded, a lot of businesses were sold, businesses went public. Now, in the last 24 months, where that capital markets play, the arbitrage is significantly reduced, and you're forced to build a sustainable business, that's changed behavior at the portfolio company level as well as the investor fund manager level. You don't have an easy playbook to run. You've got to recruit the appropriate people, build a leverageable technology stack, and go after key customers and have a clear path to market, building the appropriate funnel. Again, the things that build long-term economic value to support the valuation. And so to now get to the answer to your question, we are focused much more on execution, on operational plan. the backgrounds of the team members to be able to deliver that, what their path to cash flow break even is, to remove or reduce capital markets risk. And so our diligence is much more focused on that today than it used to be. And to your point, that's a good thing.
Yeah. I'm curious on some of the ones you've made as investments in it, in maybe earlier times, and then the question is there really enough margin in this business? Am I giving you a product that actually somebody's willing to pay for and the company can make money? And so have you had some examples where like that's a transition where maybe in the beginning that wasn't the core question, and then as it's gone on, it's forced teams to basically take a hard look in the mirror and basically answer some questions and maybe make some different changes in their either in their product or in their pricing?
Yeah, and I would go high level and then drill down to the specific answer to your question. The behavior of a fund manager, again, especially as money was flowing in, you had a lot of first time funds, inexperienced earlier stage investors, including us 5 and 10 years ago. They were looking at how can I deliver returns to my investors. It was less operational and execution, more capital markets. And so you're focused on raising money to get to an inflection point in valuation, keeping oxygen in the room. And so we had one specific company we invested in where they delivered a meaningful step function increase in pre-money valuation between seed and A, and everyone considered it a win. It was an incredible multiple of a very small ARR. And what happened was they weren't delivering top line growth. And so their valuation was misaligned with the value they were creating in the business. To your point, are you generating a return?
Yep.
That doesn't sit well with investors, depending upon who controls the board. It doesn't sit well with founders. It's taking years now to grow back into that valuation. You can have disruption in team if they see their options aren't worth anything, they're out of the money, they'll jump to something else. Misaligns near-term decision making, risk taking. The investor could default to their liquidation preference rather than trying to grow into a valuation. So a great step function increase in valuation in an earlier stage company is not always a good thing.
Yeah, I think it's a really good point. And I think we've seen that before. So I think that's really helpful. So good. I think one of the things that I think as I started working with you a little bit, I started to understand a little bit more about how you think about returns and the value of IRR, internal rate of return versus just a multiple and market value. And so really this is the function of time, right? Where it's like, if you're not looking for something that's going to be $1 billion exit for you, then basically you're looking at deploying your capital from your LPs, and basically the rate of return on a yearly basis is really important. So I think that's a good distinction, because most of these people that are going to raise money are not the unicorns. They're not the ones that are just basically looking for VCs that are looking for 100x times their money in it. So maybe talk a little bit about like how you define success and really the metrics around kind of internal rate of return, because I think it's important for entrepreneurs to understand that.
Yeah, it's disclosure on the structure of my firm and my entity, Badlands Capital, and how that affects the behavior you're referencing. We have institutional limited partners. It's not individual investors. So we have foundations, family offices, corporations, banks, and they expect us to deliver a risk-appropriate return. So it's not just IRR as measured in percent. It's what are you delivering for the risk you're taking. Earlier stage company, they expect a higher return. And IRR is a function of, to your point, multiple and time. The timing of cash flows and the magnitude of cash flows. So to us, if we're going earlier stage, and for us, let's just say that's Series A, in today's environment, in a properly valued, mature buyout, I can get 2 to 2.5 times our invested capital. Returning 2 times your capital in 5 years is about a 14.5% IRR. If I get that done in 3 years, then it's more a 20% IRR, and our LPs would be very happy. But if I'm putting that same money in an early stage company with all of this execution risk and capital markets risk we're talking about, that had better be a 3, 4, 5 times our money. So then it becomes a math problem. The investors that are focused on return want, for that 3 to 5 times our money, a 25 to 40% IRR. These companies with capital markets risk take longer to get to an exit, especially in the fundraising and capital markets environment we're talking about today. So you're raising A1, A2, A3 to get to an inflection point where you can raise a B. That's capital markets risk extended. It's also time extended. So the time consideration in IRR is longer today than it was in the easy money period of time. So for a founder in today's environment, they need to be looking at more than a 2 times multiple of invested capital for the investor in a 3 to 5 year period of time. And if there's uncertainty on both multiple and time, that's when a venture capital firm or private investor will often say, it's not worth my time. So keep in mind, Todd, it's also a function of ownership. If I'm investing $5 million and I've got 10% of the company, they're at Series A and the founders still own a meaningful portion. For me to get 3 times my money, I need $15 million. And I own 10% of the company, assume we don't raise anything more. It's got to be a $150 million company.
Yep.
And so does this company have the addressable market, the team, the product, the funnel, all of the execution things we're talking about to get to that level? If they don't, then
the time frame that you want.
Yes, right. In the period of time where the capital markets risk is heightened and an exit is less certain. So you're exactly right. In today's environment, there's multiple uncertainty and certainly extended time.
Yeah. Yeah, it's a good one, and I think it's a good frame for anybody that's thinking about fundraising to kind of go through. Do you think that maybe to close this section of it, do you think that people will do maybe smaller rounds and less of them with more of an idea of saying, the idea like saying, hey, look, I'll take a couple $1 million, but really my goal is to get this to 30 or to $50 million versus taking, 5 to 7 and trying to get it to 100, 150 million. And there's chances of dilution and all sorts of things that go along with that. I think some of the conversations I'm talking with them, they're already starting to think about, how do I just do one round and be done? And that's super hard, but it does change their mentality. And I think they're a lot more capital efficient in the way they're thinking about it. Do you think that that's a trend that will continue, or do you think that's something that's coming? I don't know. I've only had a couple of data points on this, but I'm curious your perspective.
I think, especially in this region, that is a better path for an early stage technology company. Because again, in this region, you have less access to capital, increased capital markets risk, potentially longer period of time to get to an exit. So it's a flywheel the wrong way in that I want to raise more money. There's less available. I'm not showing the traction, so there's even less money available. And so you get into the death stall. Yeah. And so if you can be capital efficient, which most of the companies around here are, raise less capital, have a point in time where you remove capital markets risk by getting cash flow positive, and your exit may not be sale to a coastal $500 million software fund, but instead sale to a strategic who, again, they're showing growth slowing. They need to drive growth. I think there will be more and more strategic acquisition of differentiated technology and team, and that may be more of an exit. Or just people in this industry think lifestyle business is a dirty word. Build a strong margin, 10, 20, 30 million in value technology business and run that business. And again, the focus is building a sustainable business that's creating value. Capture more of that value for yourself rather than selling it to an equity investor. So I think there's more and more of that, especially in this region, and we're more and more interested in that.
Yeah. Well, that's good. I mean, I think it's a healthy way to think about it, and it's certainly an option. The next question I had for you was one. I was doing some work with a startup, and they were raising some capital. This is a Series A, and they hadn't hired a ton of people, and so they basically got through the whole Series A process, and then basically went back to add an options pool for their employees. So they went back and said, "We'd like to add 15% option pool for all these people we're going to go hire now that we got cash." And shame on us. We probably, both sides should probably have realized that this is a problem, but it created a lot of consternation with the investor, as well as it didn't get us off to a good start with the startup. And so, from your perspective, maybe just talk a little bit about this. I mean, having an option pool for the employees you're going to hire is important, but really, it's the dilution that the investor is going to take because of that basically created the friction. So, I'm curious about your perspective on this and what you see. Is this something in the diligence process that you'd always look for? Just to make sure that it's a check mark that they've got it allocated, or ask the question if they don't?
It is. And I think a potential new investor should be looking at how much do I own and what is the fully diluted ownership. And another important question that I've run into with larger funds we're trying to recruit as investors into existing portfolio companies of ours, they should be focusing not just on the math, but on how much does the team own in the form of founders' common shares and option pools to grant to other team members. We've had, in one instance, a fund say, we don't think there's enough ownership available to the team, and especially the founders. We're less interested. So that absolutely is part of our diligence. It should be part of other funds' diligence. They may top off the option pool to grant some more to the founders to make sure that there's economic incentive to do all the hard work necessary in an early stage company. But then it's also part of the math we've just talked about, Todd, where how do you know what type of return you can expect at various exit values if you don't understand your fully diluted ownership at the time you're wiring?
Yeah, I think it's a really good point. And I think, and it's funny, like, I don't think that the entrepreneurs are ever trying to pull something over a fast one on the investors. It's just an education piece of this and trying to look down the road. I think sometimes they're so focused on what's in front of me and how do I just do the next job. And I already have 5 alligators that are very close to the boat. What do I do? That some of these things about thinking long-term and option pools and incentives and making sure there's enough skin in the game for all the different critical players in a company is super important.
Right.
All right, let's talk about another one. And I think this one's been more of an education for me too, about just, each investor organization has kind of a lifestyle of their fund. And so they raise a bunch of capital, they start to deploy it. And you kind of got you got an early component, you got a middle component, you got an end component. And then the successful ones continue to the next fund. And so maybe talk to me a little bit about how important it is for an entrepreneur to understand where this investment money is in the fund, right? If it's at the beginning, does that give them plenty of time for an exit and basically some of this IRR that we've talked about? Is there more pressure if it's at the end? What happens if there's kind of split funds where part of the money is coming from one fund and they're starting the next one? I think a lot of times entrepreneurs don't really understand this as a factor that they need to at least ask some smart questions about.
Mm-hmm. Yeah, I think the math of venture capital and private equity affects behavior. Was it Charlie Munger, show me the incentives and I'll predict the behavior?
Yep.
And so what drives a lot of behavior in private capital investing is your fund documents with your investors. Middle of the fairway standard documents, you have 5-year investment period. You can invest in any new company for the first 5 years. You then have an additional 5 years to harvest, so it's a 10-year fund life. And so to your question, 2 things. We talk about time and cash flows. How much time do they have left in their fund either to fund a new investment? And how much time do they have to the end of the fund life, which forces them to do unnatural things? And so that is a great question for a founder or management team to ask. I would say another way to look at it, or another series of questions, is not only time, but how much of your commitments from your investors in this fund are left to follow on and support us?
Yep.
Because if you're early in a fund life and they're reserving as you hit milestones is the best. If they're late in their investment period, they can still follow on beyond the first 5 years. But if they've got a $100 million fund and they've already called 80, there's less of it available to back you. And so where in the fund life, how much of the commitments are left? What's your limited partnership agreement say on percent of commitments in any one investment? That can be 10 or 20%. That's another binding parameter on the investment or the investor supporting a portfolio company. And so asking questions about the limited partnership agreement is diligence from the founder to the potential investor. And I think that's really important. You've mentioned the successful funds every 3 or 4 years are fundraising the next fund. That certainly was the case in the easy money environment. Another dynamic over the last 24 months is you're posting valuations to your LPs on a quarterly or annual basis. You're not seeing the ramp in mark-to-market valuations. Investors are less interested in following on until your portfolio matures. So you've now extended the period of time from close of one fund to the next fund. And so you have less capital in a new vehicle to follow on. The team at the venture capital firm may be stretched because they haven't been able to raise another fund and hire additional people. So it's great diligence on the part of the venture capital company to the venture capital firm.
So do you feel like this is a just a transparent question to ask in kind of the diligence process where, the entrepreneur just asked the investment firm, like, where are you in this? How much have you deployed? What's left? I mean, I think in some cases people are a little bit hesitant because they feel like they're getting interviewed, right? They're the ones getting the diligence information. And so sometimes I don't think they feel as confident asking some of this of the investment organization. And so, I mean, is that normal? And do the people feel comfortable doing that? And are people pretty transparent about it?
I think along two fronts they should do it. One, because it's an important consideration for the business, their business, and who they would potentially bring in as an investor. And so it shows experience to the venture capital firm from the founders. We get this. We know this is a risk to us. We want to understand this risk. In addition, I think it aligns. We talk about venture capital partnering with founders. If you ask the question and the potential venture capital firm investing in your company is not transparent, then you should be less interested in bringing them in as a partner.
Yeah, that's a good point. That's a good point. Maybe just a red flag to ask some more questions.
Mm-hmm.
Yeah,
right.
That's good. So maybe my next question is really kind of how do you think of some strategies that entrepreneurs can start to leverage as they go through this? I mean, I think even in the companies that you and I have worked on, I mean, there's just been greater focus on net retention of revenue. What does really capital efficiency mean? And are we spending at the right places? I mean, we've talked a little bit about just maybe more rigor on the financial reporting standpoint, where there's just more transparency. And you're hoping that as the board gets more transparency, then it's moving down into the management layers to use that as a tool to continue to manage their organization. I think we've seen board changes as far as their involvement in them. I don't know if you want to clarify any of those, or do you think those are the right ones? I mean, there's just a bunch of things that I think have happened as a result of this and your investments of saying, how do I make these have the highest chance of success, and then really focus on some of the execution issues that you're seeing in some of these companies.
Yeah, I would say, again, with the macro important consideration of building a sustainable business that creates value, and therefore it's not a capital markets play, it's an execution play, the entire board should be aligned on what is the strategy of investing. Whether you're burning cash or cash flow positive, you're still making decisions on hiring additional salespeople, focusing on additional industries or customer clusters, investing in new product features, building out customer success as you're adding logos, depending upon whether they're SMB or mid-tier or enterprise has implications. You can't have a board member from the venture capital firm providing great value if they don't have that level of detail on your business. The earlier stage you're still you've got 5 customers and then 10 and then 15. So it may not be as detailed as one that has 500 to 1,000 customers, but you still should be capturing data and communicating it to the board so that everyone can be aligned and have input. So then to your additional point on financial reporting, you and I have seen it. We've got QuickBooks and an income statement. We don't bother putting together a balance sheet. Well, let's start developing a balance sheet, deferred revenue, and start tracking. Software and investors, especially if you're planning to bring in new investors at a future round at a higher valuation, will be asking those questions. So it's not only part of running a successful business, creating value, it's something you're going to have to put in a data room for a future investor to look at. So you're right. Not after a while, it's not just income statement and balance sheet. It's customer acquisition costs, lifetime value, net gross churn, cohort analysis, types of things that will allow you as a founder to make great decisions, but also align the board level discussion. And without that, A, it makes it harder to raise money, and B, aligns conversation at the board level if you have it.
I think one of the challenges, Blaine, with some of this is there's maybe a little bit of stretch from both sides, right? I think entrepreneurs need to be more versed in some of the finance and metric stuff. And I think the investors need to have some understanding of the operational components of it to really add value. If you just stick in your lane and you said, I'm going to run, give you guidance based on the spreadsheet, that's not great from an operational standpoint. If you're looking at it just from an operational standpoint and not looking at the key metrics, that's not a great place to be either. And so I think there is some balance, and I think your board, and I think it really depends on the types of people you have, and and making sure that you got a mixture of that so you minimize some of the friction. Because I think we've definitely seen in some cases where there's friction between those two parties. Neither of them are wrong. It's just the combination of having both of those in a Venn diagram where there's overlap. That's where the conversation should really happen.
I agree. Yeah. And alignment and transparency and granularity leads to that.
Yeah. Not always easy. But I think it's certainly important. Yeah. Okay, well, good. Kind of moving on, maybe talk a little bit about how, maybe some success that you've had or lessons learned from some of the ones you've done, right? You've talked a little bit about some of the manufacturing stuff that you've done, which has maybe a different risk profile, and maybe and you have kind of a playbook for that. You've talked about some of the stuff like maybe Property Meld, which is maybe a technology company, or Query. You've got some of these other ones that are maybe higher risk from an execution standpoint, but hopefully a different return. So maybe talk through about some of the success and some of the things maybe you've learned through that. Each one of them has got some successes in them, but I mean, I think that they're just interesting how you think about in your portfolio. You're looking for an adjusted risk, and so you've got a wide range of different investment types that basically are trying to represent that IRR that you think your LPs are really looking for.
Yeah, I would say starting technology and moving more later stage, mature manufacturing type businesses. The cliche is it's all about people. And to me, I think that's one of the benefits of investing in this region. Badlands is investing in the upper Midwest. We have people who are capital efficient and monitoring expenses. They're prudent. They're more focused on relationship, I think, as we are. So that helps to align. And so some of our early successes have been coming alongside coachable founders and management teams who don't think they know everything and are willing to take input from an investor, from someone like you who's done it before and has been successful. And so a broad category of success is picking good people. When I'm up at 3 a.m. thinking about it, I know they are too. And so that's an important success, not yet realized in some of the companies, but is a success in my opinion. I think creating technology businesses in this region where there haven't been many technology successes really is gratifying to me, and especially coming alongside these founders who are building something in a geography where it's difficult to create value, recruit. And so I think we've got some embedded wins in the portfolio that are a success along that continuum. Coaching them up, developing the financial reporting, the analytics, putting them closer to a successful exit, allowing these businesses, importantly, to remain here after there is a transaction, building embedded value in the headquarters rather than an entirely remote team where when you do reach an exit, they could be moved anywhere. I think that's been a success in our portfolio in the earlier stages. One of the still not yet realized successes is a software business you and I are working on together. They are not knocking off the direct to consumer or SMB, small medium business. They're going mid tier and arguably even enterprise in an earlier stage. So it's a longer sales cycle, it's a more complex technology product. You're having to solve big problems for big companies from an earlier stage company located in the upper Midwest. And I think we can see the other side of the valley of death with that company. And I think holding it all together and funding it to get to that level will be a real success for everyone.
Yeah, and to maybe put a broader point on it, their customer is not an early adopter, right? They've been kind of laggards of technology, and so I think that makes it even harder. Where it's not like something where they're early adopters and they're willing to take a look at things. They're kind of slow behemoths. But I agree with you. I think that that will be a great success. It's just a matter of time and good execution, which is great. Good to see.
And tying that back to some of our other points, Todd, on just the capital markets, higher interest rates, less capital available. If you're selling B2B, decision making is slower now. Yeah. Budgets are being cut back. Commercial businesses, larger customers are having to justify buying decisions through the finance function and upper management. And so not only selling cycles are extended, budgets are being cut. And so there isn't easy money on the purchasing side either. And the businesses that will be successful in this environment, I think, will have created real value.
That's kind of an interesting point. Concur actually probably did better. The company I used to work for did better in a downturn than they did in the upturn. When money was free and easy, like expense reporting and travel requirements, maybe didn't get as much scrutiny. When the numbers were under scrutiny, then T&E was probably one of the areas that was like heavily scrutinized, and people went out and to find solutions for it. I do think that there are even property meld to that extent, where it's like if you can find somebody that really sees the value of that and they're in a cost-cutting mode or in a mode of just capital efficiency, that there are solutions that really drive to that. And I think those are the ones that probably are going to do very well in this kind of economic climate.
Yeah, it's not a we'll make your life easier sell. It's we have a higher return on invested capital for you by adopting our software.
Correct.
And that's an education sales cycle rather than hitting a price point.
Yep, totally agree. But it's interesting. There are definitely some companies that are maybe a little bit more immune to fluctuations like that, and then there's ones that are very exposed, where it's like it's discretionary, and as soon as basically budgets get cut, these are the solutions that are on the table. Let's talk about some of the.
I think. Go ahead. I'm sorry. Just one other quick point, Todd. For the earlier stage companies you're bringing into Wildfire and consulting with, that should be an important screen too. That capital markets will change. We don't know how long, but I think for the foreseeable future, money won't be as free. So, what are you building? How will it be sold to the potential customer? To whom will it be sold? has real implications on how much capital needs to be raised and when the next round needs to be raised, because buying cycles have changed. That we're now far enough removed from the pandemic where there isn't a lot of money just flowing into the system.
Yeah, this is kind of a rabbit hole, but I think we're even starting to see and think about this at Wildfire about like, does the enterprise model of committed transactions actually start to fall apart? Is this more of a use what you want and pay maybe a little bit more for it, but it's more variable? And so it's not great for the entrepreneur, but I think from a buying perspective, breaking it up, saying, hey, look, this is an enterprise license, you're going to pay us X amount of dollars a year, either trying to drive it to value, like how much value did you get out of it and we'll get some portion of that, or it's more of a transactional model where you're paying for the utilization of the product that you're using. And maybe there's some floors so that you can basically do this. A company that my old CEO went to and bought into was called Accolade, and they're kind of in the healthcare concierge space. And so I think he would describe it as kind of Uber for healthcare. And their contracts is completely that. They're trying to reduce the amount of money that that you pay for healthcare, and they're only working with self-insured companies. But they're basically, the way their contract is saying is, we're going to take an X percentage of the savings of it. So if we don't save you it, then basically you don't do anything. And I think there is a shift, at least in the B2B world, where I think people are starting to wonder if those types of models that are more incentivized and aligned with the utilization and value is the way that entrepreneurs should get paid. And I think there's some value to it, and I think it's gonna create harder and harder conversations going forward.
I agree, and think of the second and third level effects. Can you really call that ARR if it's transaction based and not a year or a multi-year contract? And so if it's transaction based and isn't ARR, does that have implications for valuation and multiples paid? And so can I raise money without being diluted? There are a lot of things you need to consider, even based upon your pricing model and the business model you're developing.
I totally agree. But, the customer usually isn't wrong from that perspective if they're not buying. Valuation is valuation. Right. So I think there's an evolution that's happened, for the last couple of years. It's going to continue to go. And maybe this is one of the topics. So, well, getting closer to wrapping this up, I got a couple more questions. I think a lot of entrepreneurs that I talk to would ask is, we've started to raise interest rates, and now the Fed is kind of saying we're going to maybe bring them down. They've made some kind of ideas of maybe 3 different cuts in 2024. I think lots of entrepreneurs are thinking maybe the capital markets won't get back to where they were in 2020 and 21, but they'll get better. I'm curious on your thoughts on that, and just kind of setting expectations of this is probably not ever going back to the go-go days that we had, but there's probably some changes, and maybe 24 isn't a material change. Like, I'm curious on your opinion on some of this.
Yeah, I think it overlaps with a couple of things we've talked about already. A consideration in the limited partnership agreement and fund structure we've talked about is, at the end of that 5-year investment period, if I can't fund any new investment, then I may have a $500 million fund, but if I've only funded $200 million, my management fee drops. And so they won't chase bad deals, but the later in an investment cycle, if they're starting to see the capital markets improving, could be an incentive for funds to get money out and get a portfolio company stake in the ground. So there may be some of that incentive for venture capital to make those types of investments, smaller stakeholds, set a portfolio company in the next 12 to 18 months. I think we're going to still see 18 to 24 months before it improves. There are new funds raised, fresh pools of capital in the hands of experienced investors. For them to get there, they will need to have seen some realizations over the next 12 to 18 months to convince investors. And so it's a battleship, slow to turn. And I think, to your point, it's going to be more 2025. It won't get back to 2020 and 21. And so then, as an entrepreneur, I can't control that. What I can control is burn and what I'm developing and to whom I'm selling. And so extend the runway, be as capital efficient as possible, be able to tell a story of raising less, getting to cash flow break even sooner, and hold more of your destiny in your hands rather than guessing where capital markets will be.
Yeah, I think it's really good. I think your comment at the end there, just saying control what you do control, right? And I think, I think people are going to lament saying, I want my valuation to go back to 12 to 14x or 50x, whatever it happens to be. I think those things are not coming back anytime soon. The company that was probably 12x in 2021 is now 5, 6, almost with the exact same metrics. But I think those are probably much more realistic, given what the market dynamics and the execution. But like what you said was value, capital efficiency, path to profitability, retaining those clients. Those are the takeaways that execution from an entrepreneur can really do and drive value to your business. And those are the things you control. And if you do those well, the market will price that the way it seems to, and basically that's all you can really do in that point in time.
I agree.
Okay, well, good. Well, maybe one last question for you, Blaine. You've had kind of a history of doing a bunch of different things. If you had to go back and do it all again and talk to your 20-year-old self, what would you say? Like, I mean, you said you were a little slow to the game. Would you have done something dramatically different from a career perspective? Would you have gotten into this and really parlayed after college, going into kind of the venture environment, or even doing a startup? You talked about, really being an entrepreneur. And so I'm just curious, if you had to go back into your 20-year-old self, what would you do differently?
I think I would have taken an entrepreneurial path earlier. Maybe shorten the period of time I was in commercial banking. I absolutely think getting an MBA at the point I got it was a overwhelming, great economic and personal decision of mine. So maybe get that earlier, be exposed to more things. I think I was 31 years old before I moved to Chicago and saw the velocity of learning that I did. And that's, to your point, a little later in the game. So I would have jumped into a greater flow of experience. And if a rising tide's lifting all boats, own a boat. And so I would have bought a boat earlier. I think one other thing I would say is, some of it's my personality, some of it's just career path. I never really developed mentors. And I had to learn a lot of mistakes on my own, expensive mistakes. So become an entrepreneur sooner and develop mentors would have been the two things I would have changed most.
Well, that's good. I mean, I don't think we ever look back and say that we did it, that it wasn't a good summation. I mean, but we all have things that we look back and say, man, I could have short-circuited some of this. I could have stubbed my toe less times. And I do think your comment about mentorship is probably one of the bigger ones, because I think all of us, having somebody who can keep you between the rails and keep you out of the ditch on fire is super important. And I think I look at people in my career that made investments in me throughout it. And I wouldn't be here without him. So I do think that's a key piece. Right. It's not always easy to develop those people and find them. But I think if you can create value and be authentic and really value what they're doing, most people will take the time to invest in you. So that's good. Well, good. Well, Blaine, I think that was it on my script that I had. I just wanted to say thank you. I think you've been super candid with us. I think you've shared your experiences. You've given a real perspective to entrepreneurs and how they are thinking about it. You and I have had a lot of experiences kind of working with a bunch of them in the upper Midwest, and I've really appreciated it. And so thank you for taking the time to share that today.
Well, my pleasure. I know, just speaking from my perspective, founders can think venture capital on the other side is monolithic corporate. I'm a founder too. I went for a period of time not getting paid trying to build something. So I certainly have a kindred spirit with people trying to build a business, and the financial pain and naked on healthcare and just the tough things they go through. So that's maybe another just final point, is understand the human side of the other side of the table. And I think it will align interests earlier.
Yeah, that's a good way to leave it. We're all human beings at the end of the day, trying to do a job and finding some commonality and understanding. So, well, good. Blaine, thank you very much. I appreciate you taking the time.
Yeah, my pleasure, Todd. Thank you.
Yeah, bye-bye.